Welcome once again to the second bit of the financial risk management discussions. Okay, so we'll continue with where we left off. So at this point, we'll be looking at the liquidity risk and other types of risk. Okay, other types of financial risk which affects the company, especially a banking institution or a depository institution or a financial institution. All right. So we left off at reputational risk and legal risk. So let's proceed to consider the liquidity risk. So liquidity risk, like the name sounds, we're dealing with money. Okay, we're dealing with cash. We're dealing with whether we have the highly liquid resources. In accounting, they will say quick ratio, current ratio, how quickly. We're more interested in the quick acid test ratio. Okay, so liquidity risk is looking at whether the institution can meet its obligations when they fall due, and it follows that liquidity risk will arise in an obligor arising. It follows that liquidity risk arising in an obligor increases the credit risk faced by the creditor. So liquidity risk has some link with credit risk. That's what I want to mention here, especially when you tend to default or you are having a challenge to meet your credit lines or the credit requirements. So technically, um, from a technical viewpoint, liquidity risk is the risk that a firm will not be able to meet its contractual or contingent financial obligations as they arise, or that it doesn't have the appropriate amount, composition of cash equivalents, or the tenor of funding required to meet or support its assets and liabilities. The main difference between liquidity risk and credit risk is that liquidity risk is more encompassing, it's more comprehensive and holistic. It looks at not just a single line of contractual obligation. It looks at more of both balance sheet and off balance sheet items. Okay, so it will consider even letters of credit, which normally appear off balance sheet, as well as elements that appear on the balance sheet. So it is more comprehensive. Let me put it that way. So it is split into two, like I said. So funding liquidity risk, so where the firm may face cash flow problems, challenges, and it could have a direct impact on its ability to pay obligations when they fall due, okay, which will put them at risk, okay, of attracting some higher interest or the risk that they could face some litigation issues with their clients or with their customers. And also looking at the risk that where the company may not have the cash to run its day-to-day operations. Okay, so we're talking of the intraday liquidity risk. So every company needs some cash in the very short term to meet these trading obligations. All right. Two major sources or two major elements that drive liquidity risk. We have the liability side and then the asset side. Let's look at the liability reason. Okay, the liability driven reason or push. All right. Now, this occurs when the financial institution liability holders, such as depositors or policy holders, want to cash in, want to withdraw their cash. Remember, from the bank's perspective, any depositor, anyone who comes in to deposit his funds, is actually a liability to the bank. Okay, because whatever cash or funds you hold in the bank is not for the bank, it's yours, it's your asset. But to the bank, it is a liability to them. So if everyone goes to the Bank of Scotland, HSBC now, saying, I'm coming to withdraw all my cash, the bank must make sure they give us back our cash. It's not theirs, it's ours. Okay, so the liability reason occurs where, for example, all depositors go in and said, I want to withdraw my cash. What happens? At this point, the bank must make cash ready to give us, to pay us. But know that sometimes the banks may also not have all this cash. They may have given some of your money as loans to people to work with, or they might have invested it in some projects. So the bank finds it difficult. So there are three things that occur here. First, they must get all their highly liquid assets, such as the cash and cash equivalents, the easily liquidated um, securities, okay, the cash, and then pay their clients off. That's the first thing. Once they pay off, then you should know that their cash reserves may get depleted totally, right? So some cash and cash equivalents may also not be just may not be too liquid, may not be cannot be quickly turned into cash. Let me put it that way. Because if you try it that way, you may end up incurring some cost. For example, if you have an investment with a bank and it is time bound, or it has a maturity date of 1 year, and you go in, let's say 10 years, and you're going to liquidate it within the first 3 years, there'll be some penalty charges. You may even lose some amount on the face value of your investment. Okay, so firms, these banks will now be compelled, once they have paid off the cash, if they cannot meet it, what they have to do is to sell off their assets. So they sell a car which will go for like 10,000, they can sell it for 5,000, because they need quick cash to settle their creditors, the customers. And that's what we call the fire sale prices, because you sell the item so quickly at a very lower price because you need the cash. And this could threaten the solvency of the firm. And then if they sell the cash, they sell the assets to raise the cash, the next option they could also do is to borrow from their counterparts to help meet these pressing needs of the customers. But what will happen is that under normal circumstances, if they were to go and borrow, they could negotiate. But now that they need the money quickly, they may not have the time to negotiate, so they will end up paying higher interest charges on the borrowing that they'll go and borrow to pay you. So this is the liability driven side of liquidity. Then we have the asset driven side. It also works like there's just a mirror image of the liability reason, the liability push side. Now, um, where this one occurs, where the ability of the firm or the bank to fund the exercise of off-balance sheet. So, like I said, credit liquidity risk is quite different from credit risk because it is more holistic. It looks at both on-balance sheet and off-balance sheet items. So, the asset side, where maybe the company, the bank, ability to fund off-balance sheet commitments could pose a problem to them. Okay, so for example, a loan commitment, if a company goes to the bank to borrow, okay, and the bank agrees to offer them the loan, what happens is that the bank must make money ready for the company, for the bank, for the customer to cash out. Okay, now if the borrower draws this loan commitment, it means the bank has lost some cash initially, right? And they must immediately fix it. Let me put it that way. Okay, they must fund the loan on the balance sheet immediately. Similarly, for example, in situations of letters of credit, I'm going to negotiate with a with an international party, and the bank guarantees that he's gonna pay. Immediately, the bank must make this loan available so that when the customer or this party calls for the money, you pay it. Okay, so it creates the demand, the need for getting liquidity to fund these items. Now, with the case with liability withdrawals, what will happen is that the bank must run down its cash reserves to meet this demand. And anyone who goes to borrow from the bank is an asset to the bank because you are more or less a receivable. And receivables are assets to the bank. That's why we are talking of the asset side. So the bank must run down its cash to fund these assets. Okay, the loan that the customer is taking. And if they don't have enough cash, what do? They sell off their assets at a fire sale price, okay? Or if they don't have enough assets, what they have to do is to borrow additional funds to pay off this. And these additional funds could be acquired at a higher interest rate than what would have been paid in a normal situation, okay? Now, the following the financial crisis of 2008, many of these depository institutions struggled to maintain their liquidity. The central banks came in, the Federal Reserves came in, the treasuries came in to support them, some with cash, some with assistance in terms of advisory services, so that they could keep their financial system in place or their companies in place. Even with this, most of the companies failed. They had to fail or they went into mergers and acquisitions. So two main measures were adopted or were implemented by the central banks or proposed for banks, for financial institutions to take on. So we can call them measures or enhanced tools or benchmarks and metrics. Okay. And the intention was that it will help financial institutions to assess their resilience, the resilience of their liquidity cushions, and to constrain any weaknesses in liquidity maturing profile. So in effect, it helps them to be ready with cash to meet any demands. Now, these are the liquidity coverage ratio came into effect in 1st January 2015, and then the net stable funding or net stable funds ratio, which came into effect 3 years later. Now, it applies to large international active banks, not dormant banks, with 250 billion or more in total consolidated assets, or with 10 billion plus in total off-balance sheet foreign exposures. Now, what is the liquidity coverage ratio? So, you remember in our initial lecture on the evolution of corporate governance, we mentioned the Basel Committee. Now, in 2010, when the Basel Committee introduced the liquidity coverage ratio, the intention is that they want to measure what proportion of high quality liquid assets, HQLA, which are held by the firm in order to meet any estimated net cash outflows within a 30-day period in case there is an acute liquidity stress scenario imposed by the supervisors, by the central banks. Okay. So do we have highly liquid assets, high quality, not any liquid, high quality liquid assets to offset or to meet any net cash outflow within a 30-day period? Calendar days, not working days. Okay. So to incorporate or to absorb any shocks that may come up. Okay, so 30-day period window is what we're looking at. So it is given using the formula stock of high quality liquid assets divided by the total net cash outflows over the next calendar days. Whatever answer you get in percentage terms, compare it to 100%. If it is equal or more than 100% currently, then you know that the company is in a good position in terms of liquidity to meet any 30-day stress needs in terms of acute liquidity stress conditions. All right. Now, let us look at what it means by this HQLA. Okay, the numerator. So, try and remember this at a point in time. I've put an appendix there which has some more information on this. So, we have liquid assets must be maintained in liquid must be maintained in liquid forms or must remain liquid in times of stress, convertible into cash at a very short notice with little or no loss, and can be used at the central bank discount window as collateral. They must be unencumbered, no stress or no much stress on them. Okay. Um, Liquid assets are divided into two levels, level one and level two. Level two has A and B. Okay. Level one assets are the cash and central banks reserves, sovereign debts. Level 2A assets are the mortgage-backed securities, which are government guaranteed, plus corporate bonds, which are AA minus rated. And level 2B are the residential-backed securities, the residential mortgage-backed securities, but they are not guaranteed by the government with ratings of at least AA. Okay, plus any lower rated corporate bonds, plus blue chip equities. All right. Now, there's always a haircut when I use the word haircut. In a layman's language, you go to the barbering salon to chop off some hair. Why do you chop those ones off? You don't need them. Okay, you make it provision for the clean one, the clean hair. So there's always a minimum imposed on the 2A level 2A assets of 15% haircut and then 50% haircut on the 2B. So take off 15% and retain the 85. In effect, you are giving plus or minus, being prudent as an accountant to ensure that you can get a very good value based on what you think could be acquired from the market. Some assets you want to convert them and you lose. So we're putting up this haircut or provision for losses, let me put it that way. And then we have 2B, may account not more than 15%, and two may not in aggregate account for more than 40%. Okay, so that's the point there. The main point I want to highlight is also this side. All level 2 assets must not exceed 40% of the bank stock of HQLA. So you compute the level 2 assets, compare the value to 40% of the HQLAs, and take the lower of them. Okay, so that is what we're going to look at. Now, let's take an example, for example. So I've provided all these runoff factors in an appendix just to guide our understanding. And in any case of any examination, we'll be giving you all the runoff factors and then the liquidity level. So no need to worry about crunching this in your head. One bank has the following balance sheet items. Okay, so statement of financial position, cash flows over the next 30 days, cash inflows over the next 30 days from the bank's performing assets are 5 million. Take note of that. So we are giving our assets on the left hand side. Okay, the values are there, and then the liquidity levels are given in terms of level 1, 2A, and 2B. And then we have the equities in terms of more stable retail deposits and then less stable retail deposits. Sometimes you don't see the word more stable, but I want you to not to confuse you, because in accounting, once you write stable retail deposit, less stable, once you see the word less, you may be tempted to subtract. So I just plug in the word more stable, less stable, for you to know that you don't have to add or subtract something there. You don't have to subtract something there. Okay. And then, so these are all given. When you sum them up, you get the figures summing up at 410 million. Now, with all of this, what do we do? The question is, we should calculate the liquidity coverage ratio. So, do we have enough coverage to cater for any liquidity needs within 30-day window? So, there are steps. I've plugged in steps one after the other and also worked it sequentially for us to be sure we understand what we're doing. So, first, we find the stock of the high quality liquid assets per the formula. How do we find them? Okay, number one, sum up all the level 1 HQLAs. Sum all of them. And these are all held at 100%. And then number two, step two, sum up all the level 2 liquid assets, both A and B. Okay. At the end of the day, the total of the level 2 assets should not exceed 40% of the HQLAs of the level 1s. Okay. So we start. Now, level 1 assets and all have been provided here. So level 1 is 5, 15, 100, right? We add this level 1, and this will give us 120, right? If you add them, we get 120. Now we sum the level 2s, okay? I will work everything. Land and buildings are not part, okay? I will work everything, okay? So A, you sum the level 1 and you are getting 120, right? B, so I'm making it step A or point A, point B. The level 2A gives us this, right? C, the level 2B gives us this, all right? And remember, there's a haircut applied, okay? There's a haircut applied of 15%, all right? This is where you should look out for, because you will not find the haircut here. You will not find the haircut here. So I want you to remember the haircut, that level 2A has a haircut of 15%, and level 2B has a haircut of 50%. So whatever figure you discount it by these figures, okay? So this has a haircut of 15, that's why we multiply by 85. And B has a haircut of 50, that's why we multiply by 0.5, okay? After that, we sum 1 and 2, or B and C, and this is what we get. But remember that B assets should not exceed 40% of level 1. So what I will do is I'll find 40% of level 1, and it gives me 48. Therefore, I compare these against these, and then I pick the lower of them. So I pick the lower, 48. Add it to the 120 level 1, and then you get 168. That is the numerator. Then the denominator, you use the runoff factors. So the denominator, we find the runoff factors. 3% of this, 10% of this, 5% of this, 10% of this, 75% of this, and we sum them. Okay, so that's it. 0.3, 10%, 5%, 10, 75. And then whatever figure you get, we sum them. Okay, now we then subtract the total cash inflows over the next 30 days, which was given as a preamble to the question. And then we get 52. This becomes your denominator. So we divide the 52 into the 168, and we get 320. Compared to 100%, you realize it is far exceeding 100%. Once it is far exceeding, we conclude that the bank is in compliance with the liquidity requirements based on the liquidity coverage ratio. They can meet any needs within the 30-day window in case of any acute liquidity stress conditions. Okay. Now, then the next point on the net stable funding ratio, NSFR. So still, the Basel Committee introduced the NSFR. The idea is that it will measure the available amount of stable funding relative to the required amount of levels of stable funding over a higher period. Okay, so normally we assume that the available funding is the liabilities and equities, and then the required are the assets. Okay, so the standards require the LCR be no lower than 100%, and the NSFR be greater than 100%. We are talking of the same story here. Okay, so the NSFR takes a longer term look at liquidity as compared to the LCR. Okay, the longer term liquidity ratio requires a minimum amount of stable funding to be held over a 1 year time horizon based on the liquidity risk factors. Okay, looking at both on and off balance sheet. Okay, so it is intended to ensure that long term assets are funded with a minimum amount of stable liabilities, and it limits reliance on short-term wholesale funding, which was a major issue in the financial crisis. So basically, what stable funding available do we have compared to what required stable funding do we have on hand? So we simply divide the amount of stable funding, available amount of stable funding, by the required amount of stable funding. Okay. Now, stable funding, the numerator is given as a bank capital, preferred stock with maturity over over 1 year, liabilities with maturities over 1 year. You always find it on the face of the financial statement once of the balance sheet, and then the required stable funding, the denominator is measured using some supervisory assumptions. Okay, and they will be given the factors that you should use. Okay, the ASF factors and then RSF factors to use. All right. So an example, let's take this illustration to help us wrap up soon. Okay, so we have the RSF. So all assets will be considered required funding, required stable funding, whereas the liabilities and equities will be the available, okay, um, stable funding with the factors provided. So all we do is we multiply, we find the weight of each and sum them. So find the weight of the whole of the required funding against, okay, find the weight of each and then sum them. And then find the weight of the available stable funding and then sum them. And then you divide one by the other, okay, the amount of available by the required. So find the weight of the ASF, like I said, by multiplying each liability by each factor and sum them. And then do the same for the RSF. Okay. So step one, available amount of funding, you multiply each and you sum them and we get this. And then step two, for the required amount of funding, use the weights for everything. Then sum them. Here there's no haircut, nothing. So just weighted averages we are looking for. Then after that, we apply by dividing this by that, okay, the available over the required. And then when we divide, we get in percentage term 232. Compared to 100%, if it exceeds 100%, then what we can say is that the bank is in compliance with liquidity requirement based on the NSFR over a time period of what? 1 year horizon minimum. Okay. So we need to also so keep this in mind, these two computations we'll look at more in the workshop. Now let's wrap up with some other theoretical dimensions. So we need to manage financial risk, put in some strategy and controls, very key to ensure that we are safe. So normally investment decisions will typically be informed by the methods we use to quantify the risks um, to ensure that returns are maximized. In our capital markets, a lot of investors will use risk-free rates, okay, which represents the rate at which an investor should expect that he'll make some returns with a zero risk, okay. But in reality, most investment financial instruments they carry risk. They carry risk. So we have to compensate these additional risky instruments with a premium. Okay. So metrics like the Sharpe ratio will enable investors to compute the risk versus the reward of any investment by deducting from the expected return the risk free. Okay. Again, you remember the capital asset pricing model which also supports this argument. Okay, risk-taking behaviors are normally linked to revenue generation, but of course, they could be engendered in business culture, in business strategy, the risk culture, and attitudes towards investment to increase risk. We always need controls to ensure that if we are even taking any risk, we are sure the risk will pay off. Okay. Or if not, we must ensure that the risk is reduced. Okay. Controls are always important. Now, there are three lines of defenses which we could use to manage this financial risk. One is the first line of defense is the day-to-day monitoring and hedging of risk within a certain threshold. So the day-to-day activities of the organization. For example, the funding desk of a treasury function would usually own the foreign exchange risks and currency swap trades. So let's undertake some currency swap trades, some hedging so that we can reduce what we do. So the first line of defense is what do we do every day to reduce this risk, to minimize this risk? Okay. The second line of defense is that what supervisory controls do we have? Do we receive? Maybe from our line management, maybe from our credit risk department, maybe even from the central bank to ensure that we operate within our risk appetite. And then we have our third line of defense where independent assessment comes in place. Auditors will come in, assurers will come in, and then assess the effectiveness of our controls and ensure that we are operating within guidelines and regulatory compliance mechanisms. Okay. Now, there is also the risk management framework. I think it's generic. It applies to almost all types of risk in terms of financial risk management, operational risk management, name them. Okay. So the first we've always known is to identify the risk. Okay. How do you identify the risk? Put up a risk profile. Okay. Identify risk, record them in the risk register, put in some tracking measures to know whether you have to um, neutralize those risks when they arise. Okay, so the risk register should usually include who owns that risk or the risk owner. Whom can it be assigned to? The fundamental characteristics of the risk, the probability that it will materialize. If it materializes, what is the impact? What are the consequences from? So you should normally rank or flag the consequences in terms of low risk, medium risk, high risk, okay, critical risk, significant risk, material risk. So that's what the risk register should do. The next step in the framework is to undertake a risk assessment, measure, quantify them, okay, and then look at whether the impact is okay for us to accept, to tolerate, or to avoid, or to transfer, okay, to treat, whichever dimension we want to take. So it is always important to have a risk um, assessment matrix, which will look at the function of likelihood versus impact. Okay, do a risk mapping. Okay, and then assess the magnitude of the threat that the risk may pose to the organization and the steps that we can take as an organization to mitigate this risk in a cost-effective manner. Okay, so the risk assessment needs to be undertaken um, almost every time to look at the changes to exposure to the financial risk. Okay, if for example, when a major counterparty receives a credit rating downgrade by a credit rating agency, we need to put in place some changes to ensure that this can be minimized or will not be repeated. Okay. Then the next element we have to look at is the mitigation. Once you've identified, you've assessed, you should mitigate. So we should normally use risk monitoring mechanisms such as the early warning indicators (EWIs) or the key risk indicators (KRIs). And we've looked at this in terms of mitigation after we've assessed the threats. Okay, what we have to do is to put in place measures to mitigate, to reduce the impact. So it could be to reduce the impact altogether, offsetting the effect. Okay, we could also look at transferring it if we think we cannot bear it all. We can transfer part or all to insurance companies. Okay, we could also avoid it if we know it will pose a significant risk to operational existence and future going concern status of the company. We avoid it altogether. All right. And then the next option is to accept it if we think the risk exposure is minimal. If our budgetary um, dimensions or our budgetary allocation can manage it, we accept the risk and we proceed. All right, we proceed with the work. And then finally, put in controls. Put in controls to minimize this. Okay, put in controls to minimize the likelihood of it occurring or of the impact that it could pose. Now, for example, market risk exposures could be measured using evolution of the value at risk for a given period. Okay, we looked at that. Look at the probability. Look at the return. How will it impact? Okay. So put on some thresholds. Okay, they could be soft, they could be hard, perhaps sometimes. And the idea is that we want to prevent the risk event from occurring again, or want to reduce the impact so that we don't feel it too much. Okay. A good example of this is when performance of an offsetting hedging trade is reviewed for cost effectiveness and basis risk. We know what basis risk is, right? I mentioned it has to do with hedging. So the hedging instrument may be swapped for an instrument which is better suited to the behavior of the hedged trade should the need arise. So weigh the portfolio of elements or of instruments of securities that you have in your portfolio, and then check whether I have to swap some, whether I have to drop some, whether I need to put some in a different market or trade others in a different market. Okay, so these are the four main items. Now, financial services risk are always regulated. In the UK, we normally have the predominant central bank plays a key role in terms of supervisory, but we have the FCA and the PRA playing key roles over here. General public, we need protection. Otherwise, these financial institutions will take us for granted and will do their own things just to make their businesses prosper at the detriment of the customer. So companies must be more professional to customers, to investors, to corporate entities by making sure that they operate within the regulatory regimes. So yes, we have in 2013, the UK Parliament passed the Financial Services or Banking Reform Act of 2013. And this was fundamentally meant to supervise, to reform the financial services. And then we had the Financial Services and Markets Act of 2000, FSMA. After the financial crisis, most customers lost trust in the financial system. Therefore, it was incumbent that the supervisory authorities, the regulatory authorities come in to ensure that there's some sanity in the banking services. So we had the Prudential Regulation Authority and then the Financial Conduct Authority. They were established to replace the Financial Services Authority. And they have some different roles and responsibilities. Briefly, let's look at it. What does the FCA do in terms of their roles? The FCA, what are their roles? Their mandates. So the FCA was granted rulemaking, investigative, enforcement powers, and they have the, the power to protect the stability and integrity of the UK financial system. They are responsible for promoting effective competition within the system, ensuring that relevant market functions, the market functions well, and that they are regulated within the mandates of the industry. Okay. This includes acting to prevent market abuse and ensuring customers are protected given a fair trade. Okay, the overall aim is to ensure that market and financial systems are sound, stable, resilient, prices are uniform. Okay, customers understand what they are going into. And they have three core objectives. One, to secure an appropriate protection of customers, degree of protection for us as customers, to also enhance the integrity of the the UK financial system, and to promote effective competition in the interest of customers. Okay, no, so that somebody doesn't undertake some scrupulous trading activities. Then the PRA, their roles. So the Bank of England published the PRA's approach to supervision in October 2018. The PRA is a supervisory arm within the Bank of England or the central bank, governed under the FSMA, and their mandate is to ensure that the business of the firms it regulates is carried out in a way that avoids any adverse effect on the stability of the UK financial system. Also, to minimize the adverse effect of any failure of one of the firms it regulates. so that again stability could be ensured. Okay, so their mandate sometimes may overlap, but I think it is clearly stated with enough documentation on who does what. Okay, so finally, I'll end up with some introductory complexities in retail investment. Okay, now complexity in itself, we are being told, does not drive the risk, but the research has shown that the complex products are the ones which are likely to be missold. Okay, so if you come and sell to me a product which is highly sophisticated and I don't understand, what do you expect? It will be risky to me because once it plays out funny, I may not be able to detect or understand how it is working. So the FCA has defined three areas. Okay, creating an emerging risk for consumer detriment. Okay, one, the cheapest initial insurance premium is the key factor. If the insurance premium is key, if the insurance premium is cheap, that's what will prompt me to go and buy a life insurance cover. Okay, the quality of the cover and other post sales are normally not important to me. Normally, I don't think I look at the price. Okay, this is something which affects us. But where firms sell on add-on general insurance products such as legal cover, consumers do not always understand the cost and value. So sometimes they come with a very cheap price, and behind the veil, for all you know, they are trying to dupe us. You may not know. Some general insurance products have limited use and represent poor value. Okay. By the end of 2016, January, financial services had paid a total of 22.9 billion since 2011 to redress consumer complaints about how they've been sold some form of poor payment protection insurance (PPIs). Okay, so this where the FCA comes in to regulate and support, protect consumer interest. All right. Finally, the Libor, we've heard it every now and then, London Interbank Offered Rates. So that's the interest rate. Some people will say the base rate. I mean, sounds the same. It represents the interest rate that the banks charge each other for loans over a number of maturities from overnight to even 12 months. Okay, it's most used as the benchmark in the world. You can hear Libor interbank, you can hear Libor every now and then, Libor plus 3, Libor minus 1. Okay, it's used for many purposes, for benchmarking pricing of commercial loans, even individual loans. Sometimes it plays some key role there. For residential commercial mortgages. So it reflects the state of health of the financial system and also places some level of confidence in the system. But in 2012, it was discovered that some banks work as syndicates and they will artificially report lower rates than the actual amount actually borrowed. So in effect, they were padding up their profits, but others people were not seeing. Okay, so that it will give the regulators or the reviewers a better view of credit worthiness. Meanwhile, they were undertaking some criminal activities. And in fact, what happened was that fines amounting to more than 6 billion have been levied on banks in relation to offenses relating to libel, and 222 million pounds fine was imposed by the FCA in April 2015 on Deutsche Bank for misleading the regulator during an investigation. So once you violate these, there are serious consequences that you could incur. Now, finally, these 227 million was the biggest fine ever imposed. The second to 284, which was imposed on Barclays Bank, though the Barclays Bank may be for a different kind of breaching. But these unscrupulous activities have led the regulators, the supervisory authorities, to reform the use of LIBOR so that we can pursue a new alternative risk-free rate. Now, these changes will see the introduction of new alternative rates across major currencies, some of which are the US dollar secured, SOFR, secured overnight financing rate. We also have the SONIA, which is the British pound sterling, reformed sterling overnight indexed average. We have the European Union, European Euro, which is the ESTR, Euro short-term trade, and Swiss francs currency, which deals with the Swiss average rate overnight, the SARON, and then we have the TONA for the Japanese yen, which deals with Tokyo overnight average rate. And these changes are expected to take effect this year. 2021. All right, so I'll end here. And as I said, I've given you some indices here, some appendices here, so that you could run through in terms of the LCR, in terms of the ASF and RSF, and in terms of for our analysis. Good. So that is it. Looks like quite some detailed information there, but I'm sure it serves purpose. All right, thank you and see you soon. Bye-bye.